Let me first give you the overview of this rental property depreciation rules for owners. So what is actually depreciation? In simple terms, there are two ways a business can deduct the cost of assets it buys. The cost of smaller and non-durable items such as repairs or money spent on office supplies is generally deducted all at once. On the other hand, the cost of assets that have a useful life of 1 year or more can be deducted over a longer period of time. So this is known as depreciation, and those assets are called capital assets or long-term assets or fixed assets. So to actually depreciate an asset, it needs to have a quantifiable useful life. Let's say a business buys a piece of machinery for 10 grand. The item can be reasonably expected to last for 10 years. So the business can deduct $1,000 of this cost each year for 10 years. So that's 10,000 divided by 10. That's equal 1,000. Some assets, including rental properties, have IRS determined useful lifespans that we'll get into later on in the show. So basically, depreciation allows capital expenditures to lower the business's taxable income for a number of years. So this is particularly helpful for rental real estate businesses. Okay, so the IRS, according to IRS, here is what you can think of as a depreciable property. You can depreciate a rental property if it meets all of these 4 requirements. So you own the property, so you are considered to be the owner, even if the property is subject to a debt, in other words, a mortgage. You use the property in your business or as an income producing activity. The property has determinable useful life, meaning it's something that wears out, decays, gets used up, becomes obsolete, or actually loses its value from natural causes, and the property is actually expected to last for more than a year. Okay, and even if the property meets all of the 4 requirements, it cannot be depreciated if you placed it in service and dispose of it or no longer use it for business use in the same year. So this is really important. So depreciation starts as soon as you place the property in service or when it's ready and available to use as a rental property. Very, very important. So timing plays an important role here, okay? And so one thing I want to say here is that please remember what I just said. Those 4 criteria are quintessential when it comes to actually depreciating an assets for tax purposes. Very quintessential. Let's talk about how does rental property depreciation work. By the way, welcome back to the channel. We really appreciate having you here. We're having a sweet conversation about rental property depreciation rules for owners. And the one thing I want to say here is that if you buy a property with the intention of renting it or renting the property, you can depreciate the cost of acquiring the property over a period of time. There is obviously no one-size-fits-all useful life when it comes to rental properties. Some cheaply built homes are worn out after a decade or so, while some historic homes have been around for a century really or more and are still in perfectly rentable shape. So the IRS provides guidelines when it comes to the depreciation of real estate. Most real estate investors buy residential rental properties. So the IRS says you can treat this as having a useful life of 27.5 years. So please keep the number of years in mind, 27.5. In other words, you can divide your cost basis in the property by 27.5 to actually determine your annual depreciation expense. And it's not an expense, but it is an expense because you're actually are actually taking it out on your tax return and also on your income statement. In other words, one thing I want to say here is that you basically have 27.5 years for residential property. If you own a commercial property, the depreciation period is 39 years. Another important concept is that only the value of the building itself can be depreciated, not the land that it's built on. Buildings have a useful lifespan, but land does not, because when you think about it, land will never be used up. Okay, and there are a few acceptable ways to determine the value of a building versus the land it's owned. You can have the property appraised by a qualified professional. For example, a tax assessment is another way to separate the value of land. And you can continue to depreciate a rental property over time until you sell the property or you have depreciated your entire cost basis. So let's talk about what's your cost basis in a rental property. Really, you might think your cost basis is the amount of money you paid for a property, but it's not always that simple. So the cost basis for rental property is your acquisition cost including any mortgage that you obtain, minus the value of the land it's built on. If you paid 200 grand for a duplex and the land is appraised for $50,000, your cost basis is $150,000. Okay, and so when we talk about, so there are some other costs that can be included in your cost basis, including any debt of the seller that you assume, legal costs, recording fees, property survey costs, transfer taxes, title insurance costs. Can your rental property be depreciated? That's the big question here. By the way, I want to remind everybody of today's topic. We're having a conversation about IRS rental property depreciation rules. So in order to depreciate rental property, you have to meet the following criteria. So those are 4 important criteria that I really want you to really keep in mind. So you must own the property. You cannot rent a property, sublet it to someone else, and then claim a depreciation deduction. You must use the property to generate income. So for real estate purposes, it typically means you rent into tenants. So you're getting every month rental income. You must be able to determine a useful life of the property, a useful life for the property. As I just said earlier, residential real estate has an IRS determined useful life of 27.5 years, while commercial real estate has a useful life of 39 years. So 27.5 and 39. So this requirement is why land cannot be depreciated, because land is never used up. That's the 3rd criterion. The 4th criterion, the property must have a useful life of more than 1 year. This is really not an issue with rental real estate, but for other capital expenditures, it gives a good guideline as far as what property can be depreciated and what should be expensed immediately. For example, a new range you install in a rental property can be reasonably expected to last for more than a year. A for rent sign that you buy and place in front of the property cannot and should be treated as an immediately deductible expense. And one thing I also want to say here is that to depreciate a rental property, you should plan to hold it for more than a year. So the time spent here, the time that you plan to hold the holding time is really important. Okay, so if you plan to buy a house, fix it up, and sell it a few months later, what we call a fix and flip, you generally cannot depreciate the property during your holding period. And so if you are not sure whether you should claim a depreciation expense on a property you held for a short time, it's always better to consult a qualified tax professional, because we're giving you here a foundation, a very strong foundation, but your unique case might be different. So it's always better to actually have someone who can offer tailored advice. So overall, so those are the 4 criteria that you have to actually meet in order to depreciate rental property. How do you actually calculate depreciation? This is an important element to actually understand. One thing I want to say here is that if you own a rental property for an entire calendar year, calculating depreciation is straightforward. For residential properties, take your cost basis or adjust the cost basis if applicable and divide it by 27.5. Pretty straightforward. Put another way, for each full year you own a rental property, you can depreciate 3.636% of your cost basis every single year. If your cost basis in the rental property is, say, $200,000, your annual depreciation expense is $7,273. For a commercial property, you want to divide your cost basis by 39. So this gives you a 2.564% depreciation expense for each full year you own the property. It's more complicated when you own the property for only part of the calendar year. This generally occurs in the years when you buy and sell a property. In these cases, you can prorate the depreciation based on how many months of the year you use the property to generate rental income. So the IRS actually has a table for use during the year you acquire a property. It's actually on the website, and so this is really good. And we're actually going to put that table on the screen right now, so you can see here that month the property was put into service. Cost basis percentage you can depreciate. You can see that. So January, February, March, April, May, June, July, August, September, October, November, and December. So we're putting this on the screen so you can see exactly the cost basis percentage you can depreciate. So this is really important. Now let me dig a little further here. So how do you actually calculate depreciation? Now 3 factors three or four factors determine the amount of depreciation you can deduct each year: your basis in the property, the recovery period, and the depreciation method used. Any residential rental property placed in service after 1986 is depreciated using the MACRS, the Modified Accelerated Cost Recovery System, an accounting technique that spreads cost and depreciation deductions over 27.5 years. This is the amount of time the IRS considers to be the useful life of a rental property. Okay, but again, I'm always telling you, it's always better to actually hire a tax accountant, an enrolled agent, a CPA, a tax attorney to actually help you out. Okay, now, so what you want to do here is that if you want to depreciate a property, you want to determine the basis of the property. You want to separate the cost of land and buildings. You want to determine your basis in the house, and you want to determine the adjusted basis if necessary. And then you apply the MACRS of a method. Now, let me just kind of give you an example of rental property depreciation so we are on the same page, to further clarify the whole thing. By the way, I just want to quickly remind everybody of today's topic. We're having a sweet, very nice conversation about IRS rental property depreciation rules. Now, let's look at an example of how rental property depreciation works over time. Say you acquire a rental property for $250,000 with the intention of holding it for 30 years. The land value is appraised at $50,000 for a cost basis of, say, $200,000, right? So you actually take $50,000 from $250,000. So we'll assume that you don't make any major improvements or renovations right away or during your 30-year holding period. But if you did, they would be added to your $200,000 cost basis. So we'll also say that you purchased the property on September 1st, 2019 and put it into service the same month. So what happens here is that the IRS actually gives you a table that I just showed you. So the thing is, you have to really think about two things. So part of your rental property business may depreciate faster. All right. So basically, for example, the IRS considers appliances to have a lifespan of 5 years. If you install a new refrigerator in the rental property, you could choose to depreciate it over 5 years instead of considering over, let's say, over 27 years, okay, or even adding it to your cost basis. And in many cases, this is not really worth it. It depends, again, on the equipment you're trying to depreciate. Okay, so really, really important. Now, the IRS believes that they do have some guidelines in terms of lifespans. So for property, so they have something called the 5-year property: computers, office machinery, automobiles, appliances, carpeting, and furniture. And if you are renting a furnished apartment and you purchase a new sofa, you could use a 5-year depreciation schedule for it. Then the IRS has 7-year property, office furniture and equipment, and 15-year property, roads and fences. So this is really important. Now, how does depreciation affect selling? Depreciation can be one of your best friends when you own a property. On the other hand, when you sell a rental property, depreciation can be your worst enemy. Because the thing is that as you take depreciation deductions each year on your tax return, your cost basis in the property declines for capital gains purposes. Okay, so this is, and actually we have covered this on an entire show. But if you have questions, I will be really happy to answer. It's just that for in the interest of time, we're not going to delve into too much detail here. But long story short, it's really important to think about your capital gain when you sell a property that you have rented over many years. So why depreciation is such a big tax advantage for real estate investors? Well, depreciation is one of the biggest tax advantages for rental property owners because it basically provides an annual tax deduction that is not really an expense. Okay, let's say you have a rental property that produces $6,000 in annual income after expenses. A $4,000 depreciation expense will reduce your property's taxable income to just $2,000. So for this reason, rental income generally has a lower effective tax rate than virtually any other type of income. In fact, it's not uncommon for rental properties to show a loss for tax purposes, even though they're quite profitable. And the whole thing here is that's what we call in accounting non-cash transactions, non-cash expenses. It is an expense that affects your net income, but there is no cash outflow. And let's talk about other deductible expenses for real estate investors. Now, depreciation is a big and valuable tax break for rental property owners, but it's not the only way to reduce taxable rental income. Here are some of some more expenses that can be deducted. So you have property management, maintenance. So this refers to maintenance items like fixing toilets and servicing HVAC units, as opposed to any property improvements or renovations, which add to the investor's cost basis. You also have property taxes, utilities paid by you, advertising costs when seeking a tenant. Those are really important, but those are not capitalized though. Those are added as expenses, operating expenses, and expenses related to obtaining and retaining tenants. Travel expenses to and from your rental properties. However, these expenses must be reasonable. For example, you cannot buy a rental property in Florida, spend a week there on vacation, and write off the entire trip. Okay, it must be reasonable. And interest paid on the mortgage on the property, points paid to obtain your mortgage, insurance on the property, cleaning expenses, and legal fees related to operating the property. So basically, overall, I just want to say that if you think about your rental property as a business, any expense, any reasonable expense that you actually incur to maintain the business, to operate the business, to actually make sure your rental property is clean, is actually up to a certain standard, those expenses you can legally and you can fiscally deduct, not a problem. Okay, but again, I want to insist on the word reasonable here, because that's what the IRS will go for, reasonable. And so how can depreciation help you keep more money in your pocket? Well, the thing here is that depreciation, along with rental income and property related expenses, is reported on IRS Schedule E. Okay, so to illustrate how valuable depreciation can be to a property owner, consider an example of an investor who acquires a rental property for $200,000. Okay, and say that the property brings in $1,800 in monthly rental income, and we'll assume that this investor is in the 24% tax bracket. So the investor has the following income and expenses last year. We're going to put everything on the screen for you. So we have rental income, $21,600. Property management, $2,160. Property taxes, $3,000. Repairs, $1,000. Mortgage interest, $6,000. Insurance, $1,500. So when you think about it, the total income, in other words, when you actually subtract all the expenses from the rental income, $21,600, you get $8,440. So based on the property's income and expenses, the investor will have $8,440 in rental income. So based on the 24% tax brackets, this translates to income of about $2,026. However, based on the depreciation rules that we have discussed earlier, this investor will also be entitled to a $7,272 depreciation deduction. So this brings the property's income all the way down to $1,168. And even though this investor made a profit of $8,440 this year, depreciation lowers taxable income to a small fraction of this amount. Now, the 24% tax rate only translates to $280 in a tax liability, a savings of $1,746. So this translates to an effective tax rate of just over 3% on the property's and actual income. So this is why real estate investment is really very interesting to a lot of folks, and you are able to save a lot of cash over the years. And again, all this is legal, okay? And real estate property is not the only place where you can actually capitalize cost and then depreciate them. You have other places too when it comes to a business operating expenses. Now, let me give you other important information before we close today's conversation. Now, what if you did not claim depreciation on a property you own? Well, the depreciation deduction is actually a foreign concept to many rookie real estate investors. So it is not uncommon for first-time property owners to overlook it, especially if they file their own tax returns. So if you are a rental property owner and learning about depreciation for the first time, you might be kicking yourself for not claiming the expense on your previous tax returns. But there is good news. You can amend your recent tax returns to claim your depreciation benefit retroactively. You can file an amended tax return by completing a Form 1040X, as well as any schedules or other forms you are modifying. As a rental property owner, this will be what? Schedule E. And depreciation can save you a lot of money on your taxes. It is a complicated process though, but figuring it out for your rental properties is worth the time it takes. But again, please don't do things yourself if you have no idea of what I'm talking about. It's always better to actually hire someone who has the right level of expertise. So really, when we think about depreciation, you want to know how much depreciation reduce tax liability. Now, if you rent real estate, you typically report your rental income and expenses for each rental property on the appropriate line of Schedule E when you file your annual tax return. The net gain or loss then goes on to your 1040 form. So depreciation is one of those expenses you will include on Schedule E. So the depreciation amount effectively reduces your tax liability for the year. Okay, as I just explained to you, you can see how we went from 24, that's an effective tax rate of 24%, to barely around 3%. So it's really worth it. And it's also important to understand that you can recapture depreciation when you sell. So resetting the depreciation clock works well for a buyer, but what happens to the depreciation you have expensed out and benefited from as the seller? When you sell the property, the IRS recaptures your depreciation. Every year that you take a depreciation expense, your cost basis becomes lower and lower, and your potential capital gain when you sell becomes higher and higher. Okay, but after you actually sell, the IRS will recapture that. Now, we have also covered this concept of recapturing on other show at length. So if you are interested, please let us know in the comment section. We can either explain to you or we can refer you to that show. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about IRS rental property depreciation rules for investors. So we spoke about what depreciation is, how does rental property depreciation work, what's your cost basis in rental property, can your rental property be depreciated, how do you calculate depreciation for real, and we give you an example of rental property depreciation. Why depreciation is such a big tax advantage for real estate investors, other deductible expenses for real estate investors, how can depreciation help you keep more money in your pocket, and other important information. Thank you. God bless you. I'll see you next time. But until then, remember, stay marvelous.